All right. See a lot of folks now in attendance. So we will kick off this webinar. First, want to welcome everyone. Thank you all for joining today's Opportunity Zones webinar hosted by Economic Innovation Group. My name is Catherine Lyons. I'm our Director of Policy here at EIG, and I am joined by my co-host, Rachel Riley, founder of Aces and Archers. We have some great guest speakers to talk about today's topic, which is tapping opportunity zones financing for community development tax credit deals. So we are joined by Emily Cadik from the Affordable Housing Tax Credit Coalition, Jason Chamlee from Model Group, and Ira Weinstein from CohnReznick. So thank you all for joining us today and for lending your expertise on this topic, which we know is very much sought after. We get a lot of questions about this related to our work in opportunity zones, and are really grateful for your time today and hopefully imparting some valuable knowledge that we'll share. So with that, we'll go ahead and get started. I'll just go quickly through the agenda for today's webinar. We'll start off with just some opportunity zones industry updates from the last couple of months or so, and then really dive right into the meat of the agenda here and the topic at hand, and go through various federal tax credit programs for community development, use cases and project examples, some of the benefits and barriers to using opportunity zones alongside some of these tax credit programs, implications of recent and possible or potential policy changes, and then we will have a moderated Q&A. So everyone has an opportunity to ask questions throughout the webinar. Please use the Q&A chat box, or the Q&A box rather, not the chat box. It's just a little bit easier for us to track to make sure that we don't miss any questions that come through. We will leave time at the end of the presentation to have a moderated Q&A where we will get to those questions as best we can. If there's any that we miss, we will do our best to answer them afterward as well. Every webinar that we do, we record. So we get that question a lot. We are recording this, so don't worry if there's anything particularly interesting you wanted to go back and rewatch. We will have this back on our website shortly after this webinar, and alongside a blog that summarizes the conversation. So we will have that up hopefully within the next week or even before, and send that out to all registrants as well. I think I've covered all the housekeeping. So with that, I will turn it over to Rachel Riley to go through some of the industry updates and kick us off.
Yeah, thanks so much, Catherine. And for those who don't know me, my name is Rachel Riley. I'm the founder of a strategic advisory and consulting firm called Aces and Archers, which is based in Cincinnati. At Aces and Archers, we're a constellation of experts that are working with clients who are passionate about reimagining traditional models for economic growth and private investing, and all with the North Star to help expand capital access and address issues around socioeconomic inequality. So I'm really excited to partner with EIG on this Opportunity Zones webinar. It's meant to really elevate best practices, serve as a platform to address some frequently asked questions, as well as facilitate information dissemination as we all learn together. So here we're just providing some industry updates. Right at the top, I want to note that EIG has released a new set of investment profiles. The first I want to highlight is MLK Gateway 1. We'll go into that a little bit more in a few slides here, but this is a project where a local minority-owned business worked with the DC government and a community development financial institution to create a hub for commerce and technology. And again, that's in Washington, DC. The second one is Agile Space Industries, that's located in Durango, Colorado. And Agile is a small business in a rural town committed to training and hiring local residents as part of its accelerated growth strategy. We get a lot of questions about how can opportunity zones benefit local residents. I think that this is a great example of that. And then the third one there is 69 Prospect, and that's phase 1 of a larger planned development. It's adjacent to UNC Pembroke, so in Pembroke, North Carolina. And this is also a CDFI-led opportunity zone investment project. So this is where the CDFI made an investment to expand access to higher education It's a rural college town, and that town is also home to the Native American Lumbee tribe. So really important projects there. Would encourage you to check them out. In that vein, also wanted to note that EIG has added 30 new entries to its OZ activity map last quarter. There's a handful of operating business examples, and most importantly, investments in those businesses that are located outside of the major metros. So in your secondary and tertiary geographies. There's a handful of affordable housing projects that are on the activity map, as well as initiatives like SOLA's Black Impact Fund. So go over, check that out. Third, it's definitely worth mentioning that the IRS recently extended measures that were announced in June to really provide relief to opportunity funds and investors. And so we've linked to that updated notice from January, late January. So you can go check that out there. And one final thing that's not mentioned here, this is sort of late breaking news, but Novogradac released an update to its opportunity fund investment tracker. And so that happened just yesterday, and wanted to share two high level data points. Number one, they found that of the funds that they're tracking, 15 billion has been invested. And in Q4 of last year, that number was 3 billion. So activity remains strong, if not momentum continued in opportunity zones and across the marketplace. Next slide. So I wanted to provide a little bit of context about the purpose of this webinar. I mentioned frequently asked questions earlier, and one of the questions that we all get asked very often is, can you pair tax credit programs? So like the low income housing tax credit, the new markets tax credit, or the historical tax credit with OZ financing? And we're here today to say the answer is yes, and it's definitely worth exploring for a number of reasons. These programs provide equity to projects, which is really important, and they do it in the form of subsidy that can help fill financing gaps. And as we've noted at the top there, there's a significant overlap in the goals of these programs and the conditions that exist in opportunity zones. So we mentioned a recent newsletter from the OCC, which highlighted opportunity zone investments where financial institutions have been engaged. And some of those neighborhood conditions are listed in that newsletter. So again, plug that newsletter, definitely take a look at that. We also wanted to include examples of where this type of activity has been successful. And, we have listed a few here. We'll go into some of these examples, but in noting them, I want to say that there are a number of other projects that have received OZ financing alongside tax credit deals. These are just meant to be illustrative. And we'll continue to add to this list in the activity map as we go along. Next slide. So this is the MLK Gateway 1 investment profile that I mentioned earlier, which EIG released last month in January. And I'm going to provide this and a few more examples, again, just as a high-level demonstration of what's happening. Using OZ financing to support tax credit deals it's a great way to ensure that investments are creating a positive impact in communities. We're seeing it alongside affordable housing. We're seeing it used to finance community facilities and just general neighborhood revitalization efforts, all of which are goals of some of the federal tax credit programs that we're going to be discussing today. But like a high majority of community investment deals, the capital stacks can get complicated, and navigating compliance across multiple federal programs adds just another additional layer of complexity, although it shouldn't be a deterrent. So what we wanted to do here is provide just examples of capital stacks. So you can see here at MLK Gateway, this was a deal that was supported by OZs plus new market tax credits. And I think it may be an understatement to say a host of other sources of financing. This is a very, very complicated project. but that's what one of these deals look like. And then if you want to go to the next slide, this is an example of another deal that leveraged multiple sources of financing, including opportunity zones and tax credit equity. This is Ox Fiber in Frederick, Maryland, another opportunity zones profile that was completed by EIG. And you can see here, this was financed with 4% low-income housing tax credits, historic tax credits, opportunity zone financing, and other sources. And if you want to go to the next slide. This is a recent announcement, this Parkside at Quarry Yards in Atlanta, Georgia, of an investment made by the Enterprise Community Opportunity Zones Fund. And it's yet another great example, just like Ox Fiber, of how the 4% LIHTC and can be used with opportunity zone financing to deliver affordable homes. So you may notice a theme here. I'm really underscoring the 4% low-income housing tax credit and how it can be leveraged alongside opportunity zones to deliver affordable housing, because there was an important legislative change which occurred in December that has boosted this program. And so I really want to flag that for folks as something to pay attention to. And Emily Cadik is going to provide additional information later on in the webinar about the impact of that change. And with that, I'm going to turn it over to Ira, who's going to walk through the tax credit programs, as well as some great examples of deals that use the tax credits alongside opportunity zone financing.
Great. Thanks, Rachel. Can everybody hear me?
Yes.
Okay, perfect. So we're going to walk through a lot of stuff in a relatively short period of time. We're going to cover the low-income housing tax credit, although given Emily's going to cover aspects of this as well, we won't go too deep into some of the nuances that she may be covering. We'll cover the new markets and we'll cover the historic. These three are the more place-based or real estate-based credits. We at CohnReznick have also seen a bunch of financings around opportunity zones and the investment tax credit on some energy technologies as well. So these are not the only tax credits out there, but they're certainly the ones that are the focus of today's discussion. So just to jump right in, and I realize that we probably have a varied audience and different people have a different experience and appreciation for the nuances of all of these and may have more experience with one in particular or several. Or more than one, I should say, but we're going to kind of cover this on a fairly consistent basis and try and get at some of the salient points that are at least worth the discussion today. I think it's important to reiterate Rachel's point rather about among the things we want to focus on here are the facts that it, number one, can be done. And in fact, it has been done. And as you'll see, there are examples of things that were done well before the regulations were finalized. It is very complex, and I think the complexity is not something folks should shy away from, but they should go in eyes wide open. And certainly the importance of collaboration and creating some transparency around how things are getting done so that it can be replicated and even scaled, because I think that will have greater implications, positive implications for the opportunity zone marketplace and for the ability to really do some impactful projects. So on the LIHTC, just quickly, it established in '86 with the Tax Act and made permanent in '93. I think it's important because, as we'll discuss, not all of these credits are permanent. I think permanence has created an efficiency to the market, and I think that helps in how this whole opportunity zone relationship will come to greater fruition. Program availability, this one unique to the others. It's a per capita state-by-state allocation, and it is competed within each state. The applications are pretty rigorous. The process is certainly public and transparent. And as a result, everybody's very familiar with who's in the space, who gets the awards when they're made. And I think it's pretty well known, what projects are going on. From a capital structure standpoint, LIHTC lines up nicely in the sense that it is direct equity like OZs. And typically there are a variety of sources of hard and soft debt. Sometimes the investors that are investing for tax credit purposes are also lenders in a project. And it is not necessarily as likely that there would be other sources of equity. We'll talk about some of the reasons for that in a minute. The market is facilitated by both syndicators and direct investors. I think the syndicator piece is particularly interesting because those syndicators, many of them have been doing business in this space for a very long time. And many of them have, I think all of them have explored opportunity zones. Many of them have launched their own efforts in the space and are finding ways to either create a separate asset class or find ways to more effectively combine the two. Similarly, direct investors, primarily financial institutions to date, are in a position to also find opportunities to both do opportunity zone investing, LIHTC investing, or some combination. The other thing that lines up nicely is the duration here. The credits essentially flow over 10 years, recognizing that depending on how units come online, you could have a longer time frame for the credit flow. And the compliance period itself is 15 years, and the assets are often under an extended use agreement that could take them beyond 30 years of compliance around the limitations around the use of the asset. So I think that's an important element, because even though there's a consistency, a coterminous sort of credit flow here with opportunity zone benefit, there are other nuances that may make the investment a little bit trickier. As an asset class, housing is what low-income housing tax credits are all about. There are sub-asset classes, and we see some nuances. It could be multifamily, seniors. There are differences in sometimes the circumstances. We could also see mixed income, and that's in fact a place where we've seen some opportunity zone and low-income housing tax credits working together around the same asset, even if it's in a different ownership structure. I would also point out that oftentimes we'll see and you'll see in some of the examples, we'll see more of a master development. I think there was an example Rachel shared that had that as well, in which a investor could be working across both a LIHTC asset, even if it doesn't include opportunity zones in that asset, and maybe an adjacent or very proximate asset could similarly be financed with or equity provided through opportunity zones. So I think there are some interesting nuance, even if they're not shared in the same asset, that really help with the neighborhood and community development that everybody's looking to accomplish. The pricing here, this is a strong market. At points in time, the market has gone over $1 per dollar of credit. There are other benefits to be had. I think it's also a market that has sustained itself maybe better than some of the others in the wake of the pandemic and the recession that we're experiencing. That's in part because it has become a flight to quality without question. And I think the fact that we have syndicators, there's both a primary and a secondary market. I think that creates efficiency and liquidity. And I think that has helped to bolster the market. The geography is not necessarily an exact match with opportunity zones. It doesn't have to be consistently the same census tracts, because there could be lots of other geography that could include low-income housing tax credit opportunities. So there is some subset that would be opportunity zone focused. And I think it's worth pointing out that there are in many places state credits, low-income housing tax credits that are specific to a particular state. It helps bolster the capital structure. The places where we've seen the combination, and I think one of those was consistent with one of Rachel's examples, would be in a scenario where a low-income housing tax credit investor was paying more for the credit because they had used a vehicle that was a qualified opportunity fund, and therefore they were getting additional benefits and paying more for them. There's a bit of a range in how much more is paid for, and I think that just depends on circumstances. Pricing generally in this marketplace can vary depending on the nature of the geography itself. I think some of the larger markets are going to draw a higher price. At the same time, sometimes they will also draw larger financial institutions, and there may be greater flexibility depending on those circumstances and the extent to which those institutions, especially if it's a bank, may or may not have capital gains and what they might do to try and facilitate investment. One interesting thing here that I think is worth considering is, while a lot of banks don't have the traditional capital gains that we think of, many folks, especially those investing in LIHTC, do have capital gains in their LIHTC portfolio, because as they exit transactions, they've got a negative capital account, which gives rise to that gain. So there may be an enhanced deferral strategy inherent in, kind of this LIHTC OZ combination. So I think it's just something that we should be watching out for and seeing if that's an opportunity that could be exploited. Next slide. So I'm going to run through the new markets fairly quickly. This one, the newest of the three, established in 2000. The program really kicked off in 2003 or so. It is not a permanent credit. We did just get a nice extension of 5 years at $5 billion in most recent legislation. That's incredibly helpful. The program has lapsed from time to time over the period since it was enacted. And so that creates a little bit less, I think there's still liquidity and efficiency, but some of the investors typically in the new markets, which has also predominantly been financial institutions, there tend to be fewer of them. I think market entrants have just been leery of ramping up a program to the extent that they don't have a permanent credit. That's a bit of a barrier to entry. The program also unique in terms of how it's administered. The CDFI fund is the gatekeeper here, and they are a part of a process to dole out annual allocation authority, and that is given to CDEs, and those CDEs are the intermediary that facilitates this program. It is also a very public and transparent process. It's published annually as the awards are made, and information around each of the awardees. The capital structure here is a bit different. The new markets can manifest itself. The CDEs can make either an equity investment or a loan. And the predominant use of this has been for debt as opposed to equity. We've seen quite a few transactions over the years that have been equity, but it's definitely a small subset of the total deals that have been done. The credit is also leveraged. So oftentimes capital is accumulated at a fund, and therefore the investor that owns the CDE will only have a portion of the capital that makes up the CDE capitalization. So what would be happening here, if this were a combination, a true combination where money flowed through the structure, is you'd have to have the unique circumstances that allowed for the same investor in the transaction all the way through, the ability to provide equity at the transaction level, and the comfort to deal with the complexity around how you would combine the debt and equity. This market is, there are a lot of consultants and brokers that are helping to facilitate transaction activity. So they are good sources of information and opportunity. There are also direct investors, and oftentimes, just because of the public information, those investors have CDE relationships, and transactions are happening pretty organically. This credit flows over 7 years, so the time frame is a little bit different, not quite coterminous, and it's an uneven credit. The credit flows 5% a year for 3 years, 6% thereafter, and very structured exits. Most things do unwind or are teed up to unwind within that or at the end of that 7-year period. What is interesting about this particular credit program is that it's varied asset classes. It is also, in fact, the program that's most consistently mentioned in the course of thinking about opportunity zones. In fact, it was mentioned over the course of the same legislative, the use of the same census data and census definition or distress definition. And a lot of people often refer to new markets because there's so much overlap and cross-reference between opportunity zones and the new market tax credit program. So that makes for very interesting opportunities to combine here. One interesting element is that a lot of the assets financed with new markets are in fact not for profits. So debt is all that you could provide in those cases. There's an interesting example, though, of how that not-for-profit borrower, the transaction was still able to avail themselves of some OZ equity. This is a non-residential rental program, so we have seen instances where new markets and LIHTC may coexist again in an asset, but not the same ownership entity. And this is another example where you will often see this credit coming together with other credits in the course of a master development or some other neighborhood revitalization. Pricing here has been pretty strong, not quite as strong as the LIHTC market. Prices have dropped a bit recently with the recession, the pandemic. The geography, as I mentioned, is consistent, although a lot of the new market tax credit transactions, probably over 70%, almost maybe 75%, have been done in severely distressed areas. So definitionally, it may not exactly overlap. There is a bit of a secondary market here. It's not nearly as robust as exists in the LIHTC world. There are also state credits here as well. Next slide. Running through the historic tax credit, and I think I'm going to go through legislative history here again. I think it's interesting because I think legislative history should give us some comfort that given the time it took for some of these programs to get traction and to really become the flights to quality that many of that they all are, I think it took some time, and I think we should take comfort in the fact that we're still in the early days. So I think the OZs will similarly take a lot more momentum than even we've seen to date, and we've seen a lot of it. Legislative history here, this really came about in 1976 as a credit, although a lot changed over time, and it really became the credit that it is or was very recently, also in the Reform Act of '86. This one's a little different in terms of how it becomes available. It's more of an entitlement if you adhere to the plans and specs that are overseen by the State Historic Preservation Office of each state and the Park Service. So if you're doing the right kind of rehabilitation, you could avail yourself of the credit, assuming that your asset qualifies. And then to the extent that it has overlapping geography to opportunity zones, which I think is often the case, you'd be able to avail yourself of both. The good news here is that the credit itself does come into a transaction as equity. And here, again, there are other sources of capital, including various forms of debt. There are syndicators here, although it's less of a syndicated market, more of a brokered market. It's changing a little bit. The credit had been, up until recently, essentially a one-year credit or a credit delivered for the assets as they're placed in service. It's now a 5-year credit. So the compliance period has always been 5 years. Now the credit flows over 5 years as well. Here again, there are structured exits. So the time frame is unique and sometimes is a little bit less consistent, obviously, with the opportunity zones, even though this may be the place where, unlike LIHTC, where there are limitations on the rental income that can be generated because of the nature of the tenants themselves, here you have a little bit more market upside and maybe a little bit greater potential for that pop at the end of 10 years. Nevertheless, the investment for credit purposes is a little different. So asset class here is real estate. We've seen just about every sub-asset class. And I think that the variability there makes this a really interesting use of building stock. Pricing has been strong here as well. It seems like it's dropped a little bit, not quite as much as the new market. I think some of that drop has to do with the 5-year credit versus the 1-year, more so than it does with recessionary circumstances. Certainly a flight to quality. There is a bit of a secondary market. It's again more of a brokerage because again the time frame had not been as long, so harder to sort of sell into the secondary market. There are certainly state credits in a lot of places. And a couple of the examples we have certainly include the combination of LIHTCs. Next slide. I'm going to run through these kind of quickly, but what I think is important as we think about the geography, the first one having been a Northeast tertiary market, I think it's interesting because we have a tertiary market, I think a secondary market, and a primary market. So I think it's interesting to see the variety in geography among transactions that are currently using the combination of these programs. This was a city block. It was 3 different buildings, and it was done prior to regulations being final. It is a mixed-use project, so it had office, retail, and apartments, and it was over $30 million in total project costs. In this case, the QOZB and the Qualic B, for New Markets purposes, were one and the same, and this was done in a master lease structure. 2 distinct investors in the QOF, and the QOF had essentially equity that lined up with other sources of equity. The New Markets was, and this gets to the complication, was over $25 million in QEI across 3 different CDEs. The loan was just over $22 million. And there were a lot of different sources here that made up the entire QEI. This goes to Rachel's earlier point. There was $8 million in equity, but there were a bunch of different loans from both the conventional bank lender, a state loan program, local programs, grants, CDBG money, and all of this, of course, needed some bridge lending just to make it that much more complicated. So there was a lot going on here. The Federal Historic did flow through the new market structure, but then came into the asset itself directly. So it kind of made its way through the structure, but did not come through as a Quilici loan. The one issue that had to be contended with here, for those familiar with all the concerns about triple net, the landlord paid for certain expenses because this was a master lease, and we needed to avoid the characterization of this as being something that would run afoul of OZ compliance. And as I mentioned earlier, severely distressed criteria was met here, which is not the statutory definition necessarily for new markets. Next slide. So this one was a southeastern city or town secondary market, and it was part of a large-scale revitalization, which is often the case. This was a really unique asset. It was an entertainment and athletic facility, and large enough where, in order to accumulate all the allocation, there were 6 CDEs that came together here. The bank investor was also supporting bridging of some fundraising that came through the new market structure. This is the example I alluded to earlier, where the borrower under the new markets was a newly formed support corporation to an existing nonprofit. And that entity itself is a not-for-profit, and they own the base building and the associated soft costs. So that's how the separation was done. So rather than combining things where it was new markets equity through the structure, new markets equity was kind of coming sort of side by side here, or in the prior deal, rather, in this case, it's literally coming to different components. So the QOZB was a different entity from the Qualic B, and the QOF owned 99% of it. There was tangible property in this asset, and that's what was owned by the fund itself, or the QOZB rather. The key to this economically was a management agreement, and basically the management agreement had the installation of components and then management of the facility, which in turn was then sort of handed off to a third party as part of a subcontract. And in that case, the Qualic B paid a monthly fee to the QOZB. So a unique structure here that, again, pretty complicated, but allowed for all the dollars to come in effectively to navigate some of the tax issues, both structuring and what will be on the back end of this, but also create some upside for the venue itself and the potential that the QOZB sale potentially at the end of 12 years would generate some significant tax benefit to the owners of the QOF. And here again, we had severely distressed criteria that were met. And the last one was a Northeast primary market. This was a hospital building that was vacant for over 10 years. So obviously a lot of focus in the statute and regulations on vacancy. This was mixed use. Again, I think pretty unique. The lower floors were commercial and had some arts-oriented not-for-profits. And then the upper floors were what has been called shared housing. It was a particular service model that I think was unique here in this particular case, but one that I think is starting to get some traction in lots of other places. There were 2 different investors here. One was the new markets investor through one CDE, and that was a distinct investor from the Federal Historic. The OZ had 2 funds participating. And in this case, again, the Qualic B and the QOZB were one and the same. This was also done in a master lease structure. And as you can see, the percent ownership was split up amongst the 2 QOFs and the master tenant itself as well, which was where the Federal Historic came in, as well as the sponsor of the project had some ownership. There was also here a triple net issue that had to be contended with, and the coffee shop lease was the way it was done. And then the other issue here that was significant was there were some related party challenges that we had to deal with because the sponsor, the managing member, had owned the asset for quite a few years prior to the establishment of the OZ. This was a 5-year Federal Historic credit. A lot of transactions that we've seen had gotten grandfathered, so we're starting to see more and more, and we'll only see, unless legislation changes, the 5-year Federal Historic. And then this one again was severely distressed. So that's what we've got.
Thanks so much, Ira. Before I transition to Jason here, really quickly, how are you distinguishing between a tertiary, secondary, and primary market or geography?
Well, I think we're following the definitions that I sort of feel like are kind of universally accepted, although maybe that's not the case. And the way I think about it, it's the big sort of metro centers kind of fit into that primary. Those tertiary markets are I'm sorry, the secondary markets are kind of those cities, one like I live in Baltimore, or I think where you are, Rachel, in Cincinnati. And then the tertiary stuff is the much smaller kind of almost towns, if you will. Sometimes maybe they're larger metro centers, but we're trying to sort of follow those definitions, although I think that some people may more colloquially identify with something and maybe they're not technically in that market. I think in these three cases they were. So major metro center, that sort of traditional second tier city, and then a much smaller town, all of which were really desperately in need of some revitalization, and were very focused on working hard and collaborating to bring a lot of different things together, and they saw great value in the OZ piece of it.
Thanks, Ira. That question came up from one of our attendees, so I appreciate you taking time to answer it. So as Ira mentioned, I just moved to Cincinnati, and so I'm really excited to have Jason on to present about this really great deal called the Willkomen. I mentioned to him that he deserves the gold medal in creative structuring, financing for getting this deal done. And so without further ado, I want to welcome Jason from Model Group onto the webinar.
Thanks a lot, Rachel, and thanks for having me. I am honored by the invite and excited to join you here this afternoon to participate in this panel and share a little bit about what we did here in Cincinnati. And I'd be remiss, obviously, I'm speaking on behalf of this project, but you'll see as we get into it a little bit more so, by no means, and if the credit go to me, it was a pretty incredible team of really all-star cast and players, and you'll see as we go through that made this happen. So with that, I'll just start very high level. Again, my name is Jason Chamlee. I'm the Vice President of Mixed Use Development here at the Model Group. The Model Group, we exist to positively transform communities, and specifically the communities where we work. We are a private, for-profit real estate company that does development, construction, and property management in-house. We are based, again, here in Cincinnati, Ohio, across from the historic Finley Market, in a project we developed a few years back. But our territory is Ohio, Kentucky, Indiana. And really the two ways that we carry out our mission are through high impact affordable housing and what we call neighborhood revitalization, which often is, you see in some of these photos, historic main streets, places where once were vibrant, lively, and really built to be centers of communities, and have since been for a variety of reasons vacant, blighted, hollowed out. And so we are excited to bring life and energy back to those places. And obviously, everything I discussed are tools we use regular. The affordable housing tax credit, historic tax credits have played a very significant role here in Cincinnati and broadly across Ohio. New markets tax credits, as well as some of the other tools we're familiar with, tax increment financing, CDBG resources, HUD resources, and obviously here we're going to talk about today, opportunity zone resources. So we often think about these as the proverbial development finance toolbox, and different projects, different needs from a given community require different tools, but often, and more often than not, and probably more so now than ever, in some challenging environments, we find ourselves kind of commingling or bringing all the tools to bear for a given objective or mission. So that's really, I think that's the example here with Willkomen, that is a project that really used all the tools in the toolbox, and excited to talk about that. The last thing I'll just mention is really what underlies everything we do and how we do it is partnerships. Partnerships are at the core of who we are. And again, hopefully you'll see that as we go through here today, partners with everything from the communities themselves, public sector, nonprofit, community-based organizations, oftentimes community development corporations, CDCs, service providers for various types of affordable housing, but also the businesses that are in our commercial spaces and mixed use. We consider partners. We're in it together with them, and our fate and their feet's intrinsically linked. And so financing partners, architects, designers, legal team we're all on the same team. We're all in this thing together. So with that, I'll get a little bit into the project known as Welkomen. And Welkomen, if you're not familiar, is German for welcome. And Cincinnati, if you're not familiar, is a very German based and deep German roots. And so that's kind of where that name came from. But it's come to represent a lot of things, as you'll see. So Welkomen is in a lot of ways just kind of the overarching name for this very broad, far-reaching project. What I want to root us in here with the Welkomen project is the community of Over the Rhine. And this map is not the entirety of the neighborhood, but it largely is. The revitalization of Over the Rhine has been a top local priority really for the last 15 to 20 years. And in a lot of ways, depending on different niche industries, it's become a national story of what's happened in Over the Rhine. It is, I believe, either the largest or the second largest contiguous historic district in the country. So again, historic preservation is a significant part of this story, and it's just a really unique, dense, mixed use, mixed income, just special neighborhood. We like to say that when you're in Over the Rhine, you're in Cincinnati. It's that kind of place, just like the French Quarter in New Orleans or somewhere else. And for a mid-sized secondary city like Cincinnati, that's pretty special and unique. And I think the community going back decades had the foresight to put the right protections in place so that this community was not just bulldozed over in different eras of federal policy. And we had the asset saved so that we could, once the time was right and the tools were in place, bring new life to it. So this represents, again, in partnership with 3CDC, which is the Community-Based Development Corporation. You can see by this map, waves of development, whether completed projects, under review, and what's in blue there. We'll take a closer look at the blue project in a moment, but that is Welkomen. So really what I wanted to show in this slide from a map standpoint is you can see that a lot of the investment over time has been on the southern side. You'll see running east to west there. Liberty Street is a main thoroughfare that kind of bifurcates the neighborhood north to south. And so it's been pretty limited on the northern side of Liberty. And so a large chunk of this project stretches development north of Liberty and begins pushing up into the neighborhood. And then really you can see the other chunks are really kind of filling in some gaps throughout the community that was otherwise undeveloped. So it really connects a lot of dots. A couple other, and these are important because this is really where we started. We said, what are we trying to do here? We didn't say what buildings are we doing. We didn't say how are we paying for it, what's it going to cost, et cetera. So what do we need? What does this community need based on where it sits today? And there are some very key, critical, overarching themes that came out. One is just this idea of range of housing options, and really what that's looked like is, for a long time, Over the Rhine was deeply distressed, and there were not really market mechanics. It was really housing of last resort. People were trapped. The only people there were people that couldn't afford to move. Then, as the market began to revitalize, there was increased private investment and higher end development happening. There's also, to balance that out, there is a lot of concerted effort around affordable housing and the LIHTC program. Here in Ohio, at least, the best, most competitive affordable housing applications really geared toward skew lower on the income AMI bracket. And so what we saw was there was a fair amount of activity happening on the two ends of the income spectrum, but really a missing middle. And we call it kind of a barbell effect happening. And so what we wanted to do was in scale a big redevelopment strategy that went after that kind of 50 to 120 AMI level. And so the other piece of that, again, it's a mixed use community. Most of the buildings, historic buildings, have ground floor storefronts. And so there's a commercial component, but another ongoing theme with the revitalization of Over the Rhine is minority entrepreneurs and business opportunities. The stats are, I think the city of Cincinnati is something like 48% African-American, but the business community in Over the Rhine was only about 8%. And so there's this broader goal and initiative to say, we got to do better. And really the goal is for that to match up. So the goal is to get the business community to reflect the broader population. So these are some overarching objectives. As far as community input, there was 14 meetings held between the developer team and various committees of the community council. It's a very strong, active community council here in Over the Rhine that ultimately led with a letter of support and approval for our project. And then there are a whole variety of city and kind of public boards. There's a historic conservation board that went through and vetted and approved all of our designs, particularly for new construction infill. There's a planning commission for any zoning issues we had, city council for financing and otherwise. And so a pretty broad and substantial community engagement process there. So the project itself, again, this is a little more zeroed in map. You can see it's really 4 clusters. It incorporates 20 total buildings, 16 of which are historic rehab, 4 are new construction infill. It totals 163 mixed income residential units, again, targeting the 50 to 120 AMI. Of the 163, 42 are affordable and 58% are market rate, and that threshold is 80% AMI. So 42% are 80% AMI or below, and the 58 are 80% or above. But again, the rents are really geared to what we would call workforce housing, perhaps 80 to 120 AMI. And then there's about 20,000 square feet of ground floor commercial space. So this is, again, largely neighborhood-based retail and or restaurants on the bigger thoroughfares, not really, big downtown or CBD type office space. And again, this initiative I referenced earlier kind of coalesced with city and nonprofit and different partners. It's called the Represent Initiative, again, so that the business community represents the broader population at large, going from 8 to 48% is the goal. And so there's actually part of our project, one of the ground floor tenants is the creation of, and it'll be housed, the Represent Initiative will be housed there, and it basically is co-working incubator space with wrap services for minority business, entrepreneurship, training support, in some cases financing, et cetera. All in, it's about a $50 million project. Involves private debt, private equity, involves affordable housing tax credits, new markets tax credits, historic tax credits, tax increment financing from the city of Cincinnati, as well as, I believe, maybe some capital grants also from the city of Cincinnati, and then opportunities on equity that we'll get into in a minute. The project closed last summer, July 2022. And so really our closing process was most 4 to 6 months this time last year. And so we had a global pandemic come up out of nowhere in the middle of that. So that was, things were going a little too well, a little too easy. We needed some new challenge, but we were able to overcome that, again, largely with great partners that stuck with us. And it's the whole project slated to be done kind of Q1 2022. We do the historic components are accelerated first because we have a placed in service requirement the end of this year, so that the historic credits are 2021 credits, and then the new builds will spill into early next year. Well, one other note I was going to say on the 20 buildings, like I said, you saw on the map, they're scattered site. They also span 3 different census tracts, which again, if you work in these spaces, is pretty important because the census tract dictates the data and eligibility, et cetera. Now they're all highly distressed, so that wasn't an issue, but just one more nuance to work through. So the financing transaction structure itself, again, the reason I led with this generally or globally is called Willkomen, and everything I just presented is Willkomen. Really, what Willkomen is transactionally is 4 deals, 4 transactions, 4 projects in one. And so these are the actual names of the Willkomen Zoo House, which again is, I believe, German for home, is the affordable housing project. So that's financed with LIHTC and historic tax credits. Then we have Willkomen Development 2 is the biggest chunk. I think it's about 30 million of the total. And that's the new markets deal, new market tax credits, plus there's historic tax credits, opportunity zone, TIF, and debt and equity there. So generally market rate. Welcome in Development 3 is residential only. So we had a few buildings that were on side streets or kind of back streets that were not on commercial corridors that did not have any commercial in them. So they're not eligible for new market tax credits. When we started this, we explored the idea of doing carve-outs via the portion of business allowance, but some other things as well dictated that it actually made more sense to do it as its own standalone transaction. For that, there was a little bit of historic tax credits, opportunity zone equity, TIF debt and equity as well in that. And then we actually had, I believe it was SunTrust was at the table because they had in new markets, there's a small allocation set aside that sometimes CDEs commit to, and it was from a previous round, and so the rules for that was 2 million maximum, and so we couldn't put that 2 million into the broader new markets deal, so we actually carved out and did a separate small new markets deal that is really geared toward the commercial space fit out work for restaurants largely, and so the scope of that was $2.5 million, financed with the small set aside is technically a tenant financing, and so the qualic B on that one does not own real estate; they're a tenant, and they're financing the fit out costs plus again debt and equity. One key to really make this work, as it turned out, it created a few challenges I'll get to, but is again, there's a whole lot of pieces to this puzzle. We wanted to try to have as few transaction parties as possible, and talk to people that we knew we had relationships with who could wear multiple hats in this transaction. So Fifth Third Bank played multiple roles. They were a new market tax credit investor. They also were a historic tax credit investor. They also provided the senior debt on Welcome in 2 and 3. And they also provided historic tax credit bridge loans. So they were our lender. National Equity Fund were the syndicator for the affordable housing tax credits and for the opportunity zone equity. However, and it wasn't by accident, Fifth Third Bank was their underlying investor for both of those cases. So even though they were running the transaction, Fifth Third was behind it, and we were able to, again, behind the scenes with different parties, iron out some things in different parts and pieces of the transaction. U.S. Bank was also part of this transaction. So we split the new markets. We had two different investors. So they bought new markets as well, and they also bought historic tax credits on Welcome in 2, whereas again, Fifth Third bought them on Welcome in 3 and Welcome in Zoo House. I mentioned SunTrust, now Truist, also had a small carve out of new market tax credits. Cincinnati Development Fund, RBC, and Consortium were our CDEs. And then the city of Cincinnati, like I said, provided tax increment financing to make the project work. And then any additional equity was sponsor equity that we put in as part of our ownership interest. The way we did this was a whole host of condominium structures and regimes, and that's probably a whole nother webinar that probably just needs real estate attorneys digging in all that. I couldn't even explain it, the ins and outs of it. Again, we had a great team that worked through all that, but that's how we did this. And so all these, there's a whole host of condominium structures to separate all the ownership, and then each deal, as mentioned above, of the 4 deals, ownership entity owns the relative condominiums that go with their project. And then we have a whole host of documents, related party or, related cross documents. There is a co-construction agreement, co-developer agreements, operating agreements, project management, all that to link them all together, because they're obviously, just because they have different ownership, when you each own a unit in the building, what happens to the roof and who services the elevator really matters. And so that has to be part of this equation. The neat thing about this, now that we've done it all, is in practice, it's going to be truly mixed income, in that there will be cases in a building where on the same floor, you'll have a unit next to a unit, one of which is financed with new markets tax credits and the other is financed with affordable housing tax credits. Nobody knows it. And so it'll be, and again, not only financed, but the people living there follow each, affordable or more market driven, but they'll just be neighbors and nobody will know, and they'll be coexisting, just like a truly integrated community. And so that was, again, getting back to, I wanted to lead with what was the objective, because that's what drove all of this. That's why we did it this way, even though it was difficult. we just said, no, this is what the neighborhood needs. We got to do it, and this is how it's got to be done. The one thing I'll say on that note that really makes this happen, even before all these transaction parties are involved, was just the expertise of our development and I'll say service team, and that we had Nova Gradic was our accountant across all these deals, and so just the ability to put all the pieces together. And Kutak Rock was our attorney. Again, had expertise in all the different areas and could bring all that to bear singularly without having different counsel trying to figure it all out on the sponsor side. And really, what we did, to be frank, we had ideas. We had a giant whiteboard, and they came to town. I think it was pre-pandemic, while we were all still allowed to travel, but came to town, and we just had one giant whiteboard session, just threw everything up there to see what sticks. And so really they were involved from the front end, and just their expertise in all these different areas, so they can know how all the different parts and pieces can or cannot fit together, was critical in setting this up from the get-go, and making it happen. And probably if we go back and look at some of those photos of those whiteboard sessions, the final closing structure diagram probably looks amazingly similar to how we set it up on the front end. Because again, we led with what we wanted to achieve. We had the right people helping us figure out how to do it, and then we had the right partners who said yes to our vision and to help us carry it out. There was a question in setting it up just from an exit standpoint on the opportunity zone equity side. We set up the exit so that they're similar to kind of the put and calls we often see in tax credit world, but they're tied to certain target returns. So it couldn't be preset numbers. That just doesn't work for true equity analysis, but target returns. So depending on how the project performs over the life of it, will dictate the buyout option of the equity at the exit. So on to the next slide. I actually think my presentation was a smidge out of order. So let's jump to the next slide, and then we'll come back to this one. These are the last two. So these are just some considerations. And to be honest, I think the previous presentation hit a lot of these, but there were a lot of challenges, many of which we didn't necessarily see or know until we got into them with the different, really it's driven by the different program requirements. And so new markets needs to be true debt, opportunity zone needs to be true equity. So trying to find that balance. Opportunity zone needs to be true equity, but our institutional investor is Fifth Third Bank. And so even though they're providing equity, their typical box is more debt oriented. So trying to strike that balance so that there's risk, but enough, the balance of the risk return for them to make it work on their end. The compliance period. So historic tax credit is 5 years, new markets is 7, opportunity zone maximizing its benefits 10 years. So trying to work all those together and kind of what happens at each unwind. And then, the compliance period, the 7 or 10 years versus full term of investment when we model these out over 30 or 40 years, and making sure those true up and one doesn't disrupt the other from various tax opinions and analysis. I think Ira had mentioned earlier, he ran into, we also did with related party ownership and qualifying or non-qualifying assets, where we own these properties more than I think it was before December 31st, 2017, I think is the cutoff. And so that created a related party that we had to solve for. And we brought in an opportunity zone investor to help offset that. But over time, or again, with the buyout, we had to make sure that over the life of investment that never flipped, so that we would have related party issues at any point during the holding period. Similarly, with related party issues, we had Fifth Third Bank as new market investor, and we had Fifth Third Bank as direct equity investor via opportunity zone. And so we had to make sure we didn't run into related party issues on the new market side for the, there's a test, reasonable expectations test was really important to them too. So again, we had to not only look at how things were set up on the close, but how it changed over time with capital accounts and depreciation changes and everything like that to make sure it all stayed in balance. Collateral positions, events of default. Again, this wasn't debt, and so the OZ investor, Fifth Third Bank, where normally they'd have a senior loan or a mortgage, I should say, didn't have that in that case. They had ownership, and so in the event of default, they could step into ownership. things of that nature. So just working out some of those nuances that are certainly specific to this kind of transaction. With that, though, again, it was important here to get into this piece, the benefits. Why did we do it? Specifically OZ, why did OZ really make this work and push this over the edge, which it did. Otherwise, again, we wouldn't have done it. The simple answer is reduced cost of capital, which I think to me is the simple answer of what is Opportunity Zone get you. Because what's happening is it's not a cash subsidy. They're not buying tax credits or anything else like that, like these other programs. It's true equity. It's at-risk equity. But in addition to the economics of the project, there's also these additional tax benefits that enhance economics return. So in a neighborhood like this, we probably could not have supported true market private equity capital. But when we layer on the Opportunity Zone benefits, now we become competitive to private equity capital for those institutional investors. In addition to that, again, and let me say, if I didn't say before, clarify, in this case with Fifth Third Bank, we really looked at Opportunity Zone in a lot of ways substituted for what would be senior debt. So we did have a small senior debt portion the Fifth Third had. They wanted to keep that position, but largely that was Opportunity Zone in lieu of. And so another benefit there is just the flexibility. Instead of just set debt service payments, set interest rate that you're just paying no matter what the project's doing, there's ability to ebb and flow. We have preferred returns, but we also have accruals. So if it takes a few years to get going with the project, they're going to ride that out with us. And it's really this idea they're sharing in the risk and sharing in the reward. So on the back end, a lot of their upside or a lot of their return is driven by the terminal value. So when we model out at year 10 after a 10-year holding period, kind of the valuation at a sale or a refinance, they get their pro rata portion of that, and that is a large part of their return. And so again, that just provides a lot of flexibility throughout the investment, the holding period. And again, in this case, with an institutional capital, particularly a bank, for them also, they were looking at it as a CRA opportunity, and so that's just an added benefit to them to help work through the flexibility to make this deal work. And then, I'm just even broader beyond the project. Why is Opportunity Zone a key tool for community development, community benefits? Again, building off the specific example, long-term patient capital investor who can, share in the upside. Oftentimes, community benefit objectives, cost of capital, deal structure that can accommodate some targeted impacts. For example, the housing targets. And then those costs of capital or reduced can be passed on in the form of reduced rents, affordability, flexibility for small business tenants, et cetera. And then we'd skipped over. I'll just do this real quick. I know time's running short a little bit. So, I think probably Ira touched on a lot of these. Just going forward, Opportunity Zones, it's a key tool. To me, one of the biggest challenges is the period from when you have to have capital gains, and then there's pretty tight timelines of when from going capital gain to invest in a project. So it makes it really hard to build a project around Opportunity Zone from the get-go. Again, in this case, we're already talking to Fifth Third on these other ways. They had a big capital gain from a sale of an asset, decided to do Opportunity Zone, and that presented the opportunity. So that's kind of a bullet toward the bottom there, is building off existing relationships. Kind of at any given time, PNC Bank was another institutional investor in the market. So those are examples of being opportunistic as they come up, but it's in my opinion, that aspect of it makes it going to make it hard for the industry to kind of mature. So those are perhaps some enhancements that could be made to it. The other thing is currently it's through 2026, and so even the 7-year deferral benefit's no longer eligible. You have to pay your tax regardless in 2026, and so now we're down to basically a 5 to 6 year hold period for that deferral benefit. Now I believe you could still hold for 10 years and get that benefit, but all that to say that already the benefit is a little bit less than it was just a year or two earlier. So again, that's something that perhaps could be addressed with legislation. Again, I mentioned some of the other just challenges. It's by no means impossible, as we've seen here, but there's certainly challenges with commingling or twinning these projects. Again, the opportunity zone cannot be used as new market leverage. It has to be directed into the qualic B or the opportunity zone business. And so it really, for new markets, only works if you don't have all the allocation that your deal otherwise supports. If you can get the new markets, that's always more valuable to the project than an opportunity zone. Also on the historic tax credit side, if you're using a master lease transaction and your historic equity is coming in at the master tenant level, that's not a qualified opportunity business. And so similarly, you can't twin those up in that very specific way that's often used. And so they kind of have to happen a little bit in vacuums at different layers of the transaction, and that probably limits their ability to be really maximized from a benefit standpoint. So there's certainly challenges, and I think, again, we kind of led with it a little bit. I think with changes in Washington, it's just a little bit wait and see about what's coming and whether it's enhancements to this program or other programs that can come alongside it. But it's certainly a valuable tool that we continue to look for opportunities to do, either through our own investments with projects we're looking for that might qualify, and or potential third parties if it makes sense.
Thanks so much, Jason. And I think what's really important about the Willkomen and a lot of the projects that Ira discussed is that they demonstrate that it is possible. And, there are going to be some things that trip you up, like a lot of the considerations you mentioned about what qualifies alongside new markets or historics. But the fact of the matter is that you got it done. And I think one of the biggest barriers when we want to see more transactions like this, one of the biggest barriers is sort of a limiting belief that that these types of transactions can't get done, or they don't work. And so, Jason's here to show you, Ira's here to show you that they're possible. So really appreciate your time and walking us through that transaction. Thanks, Jason.
Thanks, Rachel.
And our final guest speaker is Emily Cadik from the Affordable Housing Tax Credit Coalition. I'm really excited to have her on. There was, when we talk about the low-income housing tax credit, a lot of times people think squarely about the 9%, which is competitively allocated, as Ira noted earlier. But there is another part of the tax code, the 4% tax credit, and there was a big legislative change that was welcome news from the affordable housing community. And so I wanted to ask Emily to share a little bit of that good news and how it could impact transactions that include opportunity zones financing.
Great. Well, thank you, Rachel. Good afternoon, everyone. It's a pleasure to join you. Again, I'm Emily Cadik with the Affordable Housing Tax Credit Coalition, and we represent, as our name suggests, groups focusing on the low-income housing tax credit, but a lot of the groups we work with are ones you've heard from today or heard about today, like CohnReznick and Novogradac and Enterprise and NEF, that use the credit as one of many tools in a toolbox as part of the whole community development ecosystem. So while we are focused on the credit, certainly value these conversations about how we can make all of these programs work together. And so thanks again for the opportunity. You've heard a lot about a lot of the considerations related to using the housing credit with opportunity zones, but I did want to focus on this great news from the end of last year, just a few weeks ago, related to the 4% credit side, especially as you may be considering using the housing credit in opportunity zones developments. So the quick background on the credit, the housing credit is the kind of the first of all of the community development credits, of course, with opportunity zones created last time we did tax reform. The housing credit was created the time before that. And while opportunity zones was being created, the housing credit community was fighting to both keep the housing credit in the tax code and retain private activity bonds, which provide financing for the 4% side of the program. But now we've had the program expanded and strengthened multiple times since tax reform. And we just find that, of course, as we're all seeing, the need for affordable housing just keeps growing and growing. So even though we have had increases to the program, it is vastly oversubscribed. So there were about $1.6 billion in credits that went out the door last year. As you can see, the divide here between the 9% credits and the 4% credits, the 4% side of the program is going to grow. And that's because of this change we just got at the end of the year with the enactment of the minimum 4% credit rate. So if we go to the next slide and talk a little bit about what actually happened with the 4% rate. It wasn't actually 4% until January 1st of this year. The the rate just refers, the 9 and the 4% program refer to the credit rate. The 9% rate was originally 9. It fell to about 7.2 or 3 before Congress set a 9% floor. Similarly, the 4% rate, which was initially 4%, had fallen to all-time lows around 3.07% in 2020 because it's tied to the federal borrowing rate, which was of course slashed in response to the pandemic. And so it was becoming a situation where we're seeing a lot of developments that worked in January 2020, but didn't work a few months later because the rate had fallen so low. So we made the case to Congress that we needed to set the rate at a minimum 4%, like we did on the 9% side. And after years of making that case, we were successful in the year-end tax legislation. So this has a lot of benefits. It means you know what your rate's going to be. There's no floating and waiting for the right moment for it to lock in. It means a lot more equity can go into any given development. Of course, it's still up to the state housing agencies to decide how much equity any given development needs in order to be financially feasible. But going from 3.07 to 4 is just a huge difference. And it means that a lot more types of developments are going to be possible, including ones for harder to serve populations, for example, formerly homeless veterans. Developments in difficult to serve areas are going to pencil out now that didn't before. So it's a huge difference, and just wanted to kind of show some visuals of what happened here on the 4% side. So we can go to the next slide. As you can see, so like I said, it started in 1986 around 4, but it had been just declining and declining. And then you see the onset of the COVID-19 crisis, and then that's when it really just dropped to the lowest levels it's ever been. And now there's this huge jump. So what does that mean? On the next slide, we can see a kind of example of a specific deal. So here's a development that what happens at the 3.07% rate, which is where it was just a few months ago, and then what it looks like now with the 4% floor. So I won't walk through this in too great detail. This one is just kind of a simple hypothetical housing credit deal, so we don't need to go through the real fine points here. But what's important to know is that where there were deals that just had a gap because the credit didn't make up enough of the capital stack, and there weren't enough, say, state or local sources of funding to make the deal pencil out, now you can put more housing credit equity into these deals in order to make them work. So it's just, it's going to make a lot more types of deals possible, but also it's going to make more deals possible just in terms of quantity. So whereas the 9% side of the program is an allocation that's capped for each state based on its population, the 4% side is different. You can access the 4% housing credits when you finance 50% of your development with private activity bonds. So as long as the bonds are there and the development's approved, you can access the 4% credits. A growing number of states like Washington, New York, California, really starting with the coastal states, but starting to spread throughout the country, are using up all of their private activity bond cap or very close to it because of all of their affordable housing needs. So we are seeing a situation where there is a de facto cap on the 4% side of the program in some of these states where the bond cap resources are already fully utilized or close to it. But in states that aren't fully utilizing their bond cap, there is going to be a lot more developments that are now, because they pencil, mean that they're just going to be doing more 4% deals. So we're going to be seeing a lot more developments across the country, which are very needed, especially in light of the crisis. The estimates are that about 130,000 more affordable homes are going to be built because of the 4% rate than would have otherwise been possible, thanks to Ira Weinstein for creating those estimates. So it's just something that we really wanted this group to be aware of, because it does really change the 4% side of the program. We're going to see a greater balance of 4% versus 9% deals. We're going to see a lot more deals penciling out that may not have worked before. Some of the ones that are most needed, like ones in difficult to develop areas or for these difficult to serve populations, are now going to work. And it's just something that, we're very glad to be going into a year where we are hopefully going to see a lot more on the policy front for affordable housing, to have this already taken care of. I know I did see some questions come through about what's ahead for the housing credit this year. And now that the 4% rate has been taken off the table, which was the top priority for our group and for the affordable housing industry generally for years, I would expect that we'll see some movement on some of the housing credit proposals that have been part of bipartisan efforts over the past few years, but now may have more of a chance at getting attached to some legislative vehicles. So things like increasing the cap on the 9% side again. We got our last cap increase in 2018, and I think that there's a good chance of getting that done this year. We could see things like additional basis boosts, which allow states to put even more credits into developments if it's needed for financial feasibility. So there's a lot of other changes on the horizon, I think, and I would expect that we may see and hope, we're certainly going to be working for it, for further program expansion and other changes along these lines going forward. So this is one that you could take advantage of right away. Going forward, we hope that even in the next few months, we'll see a lot more. But I'll leave it there and see what questions there may be about the 4% rate or the housing credit. And I think invite Rachel back to join.
Yeah, thanks so much, Emily. And just to put a really fine point, at the bottom of Emily's slide there, that last one, you can see that this change in this example is making a huge difference. So going from 2.7 million to 3.6 million in housing credit equity, which again, you know, take a look at some of the deals that you tried to underwrite last year, the year before with OZ financing and using the 4%, they may work now. Because of that additional equity that's going into that project. And I also think it could be more attractive to opportunity zone investors, knowing that that additional money is there to help support their investment. So thanks so much, Emily, and congrats on that big win.
Thank you.
And from here, Catherine, I think we can do Q&A. We've been answering some questions as we go here, but there's plenty more to be responsive to.
Yeah, absolutely. So I think we can start maybe with a question related to, so typically the question reads, typically when the parties with tax credit investments are looking for OZ investments, have the tax credit investors been the ones to find those investors, or are the sponsors finding those investors? So I don't know if maybe Ira, you want to answer that one if you have thoughts there.
Sure. Yeah, I mean, I think in instances where it's new markets, certainly, which is the bulk of what we've seen, it's going to be sponsors often helping to coordinate the sources of dollars. And oftentimes we've actually seen it be a sponsor that has the gain. So I'd say in the new market scenarios, it tends to be that the sponsor is supportive of that effort, if not driving the entirety of it. If it's LIHTC, it tends to be that it's the same investor just paying slightly more for the credit, in which case they're sort of already on the scene. And so they've already been identified. Now the sponsor has a role in that because they're going to be selecting, you know, who they're going to partner with for the equity. So I think the sponsor always has a role. I think it's a question of whether the OZ money is kind of contained within the investment structure that's already existing, or whether or not you're going out and finding additional equity to layer into this, which is also true in new markets, because you could obviously do it, Jason sort of alluded to this, all the way through the structure, which we have not seen yet, but I do think that technically it's possible, or you could do it sort of side by side. In either case, the sponsor is going to have a hand in it. They just will have to identify an additional source if it's side by side.
Yeah, I'll add quickly just what we've seen. First of all, I think the investors who are active in new markets, specifically, again, bigger institutions, their opportunity zone programs tend to be, you know, ad hoc, or it's some of them just aren't doing it at all. So there's not a lot of that necessarily. What we found oftentimes, even within the bank, they may be two different groups working on it. So we haven't found that they naturally are looking to play both roles or come to you in that way. In fact, what we've seen is the opposite, where they often want to kind of keep them separate. I alluded to it a little bit, and it gets pretty in the weeds, but there's actually maybe some structural challenges with being on both sides if you're in the new market investor and you're a significant owner of the Qualic B. And so I think our experiences, especially the banks, risk averse, different groups, that's not where they immediately go to. And again, in our case, we kind of had to, and it's unfortunate because again, our thinking is, hey, same group, different sides of transactions will be great, efficiencies, et cetera. But they aren't, at least to date, we haven't experienced that they're thinking in those same terms. And so it's really been the sponsor driving and leaning on our relationships to kind of convince them, hey, this works, let's do this.
Great, thank you both. I want to go to a question I think Emily answered partly related to LIHTC. The overall question is, where do you see pricing going for both NMTC and LIHTC in 2021? Emily, please feel free to expand on that. And Ira, maybe you wanted to chime in on the new market side and where you see projections for the year ahead.
Yeah, so I started kind of getting into some of the policy changes, which are going to have a big, potentially big impact on pricing. We've seen pricing dip a little bit, not as much as was feared when the pandemic began, but there's a lot of changes on the horizon that could change it further. So, if we get a lot more credits into the market, like we already are starting to see, from the 4% rate, and if the 9% side is expanded as well, that could certainly have an impact in one direction, whereas there was discussions about, say, increasing the corporate tax rate, which presents pressure in the other direction. Another thing that we're watching really closely is CRA reform, which the OCC came out with a final rule on CRA reform last year, which, if it were to go into effect, we thought could really dampen the appetite for the credit and pricing. Now, with the new administration coming in, we don't expect that rule to go into effect, but the Fed is looking at a different rule. And because CRA is such a driving factor behind pricing for LIHTC, even minor changes could have a really big effect. So it's hard to kind of forecast for the year with all of these different policy changes on the horizon, but just kind of all things to watch out for as you're drawing your own conclusions about which way some of these things may be going.
Yeah, I would just add, I mean, on the new market side, I think fewer investors is a general rule in the market. And I think that there are some bright signs about how we're going to come out of this recession. I guess technically it's probably over based on the sort of formal definition. And so I think as the banks see more sort of progress in the economic environment, I think the prices can only go up because they have come down quite a bit relative to the pandemic and the recession itself. I think on the LIHTC side, I guess to Emily's point, there are a lot of sort of externalities out there, and some of them are, very related to the pricing. Even on the 4%, we've already seen, folks that are now able to capture some incremental dollars on projects that were sort of underway where they're getting effectively a higher price, however slightly. So I think that's sort of positive signs around where the pricing should be going.
Great. Thank you both. Rachel, I think this one may be good for you. There are certain tax law limitations on the ability of individuals to use many of these tax credits. However, if some of these limitations were removed, would it create more synergies by having the same individuals both invest in the tax credit and obtain the benefits under the OZ incentive? And of course, anyone's welcome to chime in here as well.
Yeah, I probably can't speak too much on tax law limitations or reforms to how investors are engaging with certain tax credit programs. But one thing that I do want to underscore here is that when we're looking at the transactions that we just presented on, a lot of the investors have been financial institutions, and a lot of that work has been motivated by CRA mandates. And so Emily mentioned CRA reform. I think it's a really important place for institutional investors to play within the OZ market. Institutional capital has been slower to arrive in the opportunity zone ecosystem. And so as we see banks really supporting these deals that include tax credits for different motivations or levels of expertise, I think it just further underscores the importance of ensuring that CRA credit that these types of activities are eligible for CRA credit, because I know that that is a motivating factor in why they're participating.
Thanks. Other thoughts on that?
Yeah, I would just add that, I mean, I think it is a great point that the fact that the OZ market to date has been more likely high net worth folks than institutional, and yet it's the reverse in the tax credit space. The new markets program, I think technically, at least when it manifests as debt, there's this notion that it's sort of portfolio credit and individuals could participate. to shift to equity and maximize this, which I think is the suggestion, it becomes much more complicated, particularly because individuals tend to not have the ability to necessarily know that they're going to have a multi-year liability in the way that institutions do. These institutions often have a sort of insatiable appetite for credits under any circumstance. And so I think it's just harder. I'm not aware of significant efforts, maybe any efforts to change things such that you would see a greater alignment. I think you'd continue to see individuals come in on the OZ side when they can, and still institutions on the tax credit side. And hopefully when institutions can play the role in both, they'll be able to. I think Jason made the point that in the new markets context, allocation's hard to come by. So you're usually not maximizing the subsidy anyway. So there's a need for additional equity, and therefore it can and often does come from an OZ fund, for instance, where individuals are amongst the beneficiaries.
Thank you. Jason, I think this one, you kind of alluded to this a little bit at the beginning of your presentation. There's a question related to if there's any examples of a project that has a portion of the project inside and outside of an opportunity zone. So it sounds like you worked across a few different census tracts, and wondered if you may be able to provide any insights there, and of course others, you know, from your experiences as well.
Yeah. So what I would say, and again, portions, and I used the term earlier, portions of business has some very specific things as it relates to tax credits, as a way to kind of carve out perhaps if a portion of a qualified business that does apply or not apply. But I think the way I understand the question, again, especially because these fall across census tract boundaries, you either apply or you don't. The difference is, I think the way it was described, if you have a project that some of it's in a designated or qualified track and some is not, probably what you end up with is effectively two projects, because you're going to have a qualified opportunity zone business owning the one part and a different business owning the other. And then you just, again, probably gets into legal and accounting of kind of how to link those two together. So I've done stuff like that, again, a little different than opportunity zone, but you know, if you have, for example, historic tax credits, maybe those two businesses both lease to the same master tenant, so you can consolidate your transaction elsewhere and try to get some efficiencies of scale, so that it's kind of two projects, but kind of not, depending on the thing. The one question, maybe it's a good question for Ira, I haven't seen it, but it doesn't mean it doesn't exist, is whether there's a similar portion of business carve-out rule within a qualified opportunity zone business in the same way that there is for the qualified.
There really isn't. I mean, I think, you know, definitionally, you've got to meet the test. And so I think that there is, in the sense that there's language there that allows you to sort of, just the qualification generally looks at, you know, kind of the nature of the business and the way in which you're going to qualify. I think the percentages themselves get you to a point where I guess you could argue you effectively have a portion, but I've not seen a practical situation where that's come into play in any significant way, and typically more on the operating business side in any case.
That's true. But at that point, maybe, again, you just get in the weeds pretty quick, and so it's very situational. But I believe that the rules are around 70% have to be basically qualifying assets. And so there is some leeway where you can have a little bit in that opportunity zone business that's not. Now, again, that might be property that you've owned too long. There's usually, when we're doing deals entirely in an opportunity zone track, we're kind of soaking up that 30% in other ways. But there may be some kind of version of that, depending on the scale, to have a little carve out. So.
Yeah, and I think, Jason, you're referring to the bad assets test. Yeah, and Ira, just curious if you're seeing anyone utilize the straddling property definition.
We haven't. I mean, but certainly you know, you may have that. We've had situations where people were very proximate and thought, oh, it's close enough. We've not had anybody that was actually straddling that was in a position to do something, but therefore you could get into how to define and how to allocate and how to get to a point where part of it was outside, but all of it could qualify in theory.
Yeah. Great.
I just haven't seen it in practice.
Thank you. Well, I want to be mindful of everyone's time, and I believe we are at we are at time for this webinar at 4:30. So we've got some great questions that unfortunately we just didn't get a chance to answer. We will aim to do that in our recap blog as well. So I just we'll note those that we didn't get to, or feel free to reach out to us, with more specific questions. All of our contact information is listed here on this slide. I want to thank everyone again for joining. I want to thank our guest speakers for joining. It was really great to have you all and learn from all of you and your expertise. And we will post a recording as well as our recap blog, as I mentioned, on our website shortly, and share that with all of the registrants after this webinar. So thank you again. Rachel, any final words, or did I cover it?
Yep, you nailed it, Catherine. Happy to partner with you guys on this. Thanks,
Great.
guys.
Yeah, thanks to EIG for putting this together.
Mhm.
Great.
Absolutely.